Hey, what's up, guys? It's Mike Frank with Berkshire Hathaway, Frank Oliver and Company, coming to you to talk a little bit more about that debt that we talked about last week, right? So we brought up things like student loan and auto loans and some bad debts that you might be carrying and trying to figure out exactly how to buy a home in today's market. Well, today we're going to talk about getting a loan with student debt. And there's a lot of things that people don't understand. The first thing that they don't understand is what type of loan do they qualify for? So there's three predominant types of loans. Let's call it four, but we're going to have conventional standard mortgage loan, FHA, backed by the government, VA, obviously a veteran's loan, and then USDA or other non-conforming loans. There's lots of them out there. But let's just base our basis off of that idea that you're going to be getting a conventional, FHA, or VA. Now, what people often think is that they have student debt and they can't qualify for a mortgage loan. If you remember from last week, we talked about getting your debt in line and getting your income in line and creating a ratio therein, right? So how much debt do you carry? How much income do you earn? And the ratio therein is going to direct you to the different type of loan program that you're going to be able to afford. So with a conventional mortgage loan, and don't quote me, but with a conventional mortgage loan, you're going to be talking about a 50-ish% debt to income ratio, which means that if you have $1,000 in debt and you have $2,000 in income, that's your maximum allowable debt to income ratio based on that loan program. Let's say that you have $4,000 in income and $1,000 in debt. That's going to mean that you have $1,000 to put towards a home purchase. So the same thing, we're going to talk a little bit about FHA. A little bit more of a government-backed security, costs a little bit more opportunity for you. It's not quite as equitable, and it's going to have a little bit of a benefit-loss ratio depending on your circumstances. But that debt ratio is a little bit higher, sometimes as high as 50, 55, 57%, just depending on exactly what you qualify for. And again, don't quote me, don't yell at me, Ryan. I know it's not my area, but it's one of those things that as you're looking at your numbers and you're trying to figure out, can I qualify for a mortgage loan? It's just another option for you. So the VA option, right? That's our third option here. And the VA is actually going to give the most opportunity to our buyers that qualify. Now, remember, qualifications are limited and it depends on your circumstances. But if you served in the military and you have the eligibility requirements met, you could qualify for a VA loan, which is up to something crazy like 60% debt to income. Now, again, if you don't qualify for the VA, you're not really going to be looking to buy that loan. But conventional, FHA, VA, and then again, we have USDA and more non-conforming loans. But let's just base our thoughts off of that. We're going to start with the idea that we have debt and we have income. And inside of that debt is all of our student loan, right? It's just a factor. It's one of those considerations that people oftentimes forget how to qualify the student loan. So again, you want to talk to a mortgage lender, but let's just talk about another way that you might be able to afford a property with that student loan. Well, one of the things that a lot of people come out of college with is student loans, but also credit card debt. It's a really bad habit that we have. We get a credit card, we're at Macy's, we're shopping, they offer you a credit card and you swipe, all of a sudden you have $1,000 in debt that you didn't even account for. And all of a sudden you're trying to figure out how to buy a home. Well, let's pay off that $1,000. It's going to free up $25, $50, $100 in monthly debt, which then changes your ratios, which then will create an affordability for you to buy a home. Now, you might be able to pay off more debt swiftly. You might be able to take some of the money that you were planning on putting towards down payment and closing costs to pay off that debt, eliminating that and creating more purchasing power for yourself. It's going to create a little bit more cash flow for you to pay off other debt. It's going to create a little bit more opportunity for you to build your credit. It's going to create an opportunity for you to ultimately afford more home. Now, creating the opportunity to pay off debt with another debt is another consideration that you might want to talk with your mortgage lender first, but ultimately it's going to free up that debt to income and create the free fall that's going to open up the opportunity to buy a home. Now, another thing a lot of people are doing in today's market is increasing their income, especially with so many different things like Grubhub and Order Up and Uber Eats and things of that nature where people could drive around, make a whole bunch of money at a short period of time. And that is awesome, except my mortgage lender is going to yell at me because you need 2 years of history with those. But one of the things that those secondary or subordinate incomes can do is pay off that debt. It also can be savings that you allocate towards down payment and closing costs. Remember, debt is the first step. But once you make an offer, you're going to have to buy a home. There's going to be expenses like taxes and transfer charges that you do have to pay. And ultimately, if we can use those subordinate incomes to pay those expenses, it's going to help you make that transition even more smooth. So as you're considering your student loans as this insurmountable mountain to climb, the government has got your back. So there's a program out there, and if you want to Google it, Google Maryland Mortgage Program. For my friends in California, take a look at it. It's quite an awesome program, and it's an opportunity that you guys might be able to create structure for the buyers that you're working with. Maryland Mortgage Program came out with this something like 8 years ago, and it was an awesome program. It was allowing buyers to put down towards the closing costs and with their out-of-pocket expenses, especially with their student loans, to pay off that debt and free up that cash flow. Then they realized that they wanted to make it more available. They made more money out there, more availability, and it conformed to more buyers. Well, with COVID and some of our restrictions, you'll notice that if you go online, there are some restrictions as simple as if you have student loan at this number, and I'm not going to throw the number out there, but if you have student loans at this number, that's the maximum allowable, which means that if you're $2,000 over that number, you have to pay off that $2,000 in order to qualify for that loan. But remember this, we had a buyer 2 months ago, Roxanne, yeah? Check in with Roxanne, right? It was about 2 months ago, and Roxanne had let's say it was $6,000 over the capacity, right? Which means that $2,000 number became $6,000 number, and it was just insurmountable for her. Well, what we ended up doing was we aligned her expectations to pay off that $6,000 bill, wiped away all of her student loans, and freed her up about $450 in monthly debt. Now think about what $450 can do on the debt line when you're looking at your income, which is stagnant. Removing that $450 debt is thus going to create more opportunity based on your debt to income ratio to buy a bigger home. And that's what we did. Not only did we buy a bigger home, but it was well within their comfortability monthly because they were looking at this price point. They didn't take it as an opportunity to jump price points. They kept it within their comfortability. They eliminated a $450 monthly debt utilizing the Smart Buy program, and it creates a whole lot more buying power for them. Now, as you're considering buying with a student loan, the first thing that we're always going to tell you is get with a mortgage lender that you trust. And of course, we can get you to our lenders over there at First Home or here at PenFed or some of the other banks that we work with, but really excited for you guys to learn more about how you can qualify and create an opportunity for yourself utilizing the grants and the down payment assistance programs that are out there. If nothing else, take that subordinate income, pay off some of those secondary debts, that credit card that you didn't realize that you had, that medical bill that you didn't realize that you had, that little $50 bill that you keep paying on and never pay anything towards principal. Let's get that gone, and it's going to create more opportunity with your debt to income ratio to buy a bigger home. Now, as always, reach out, DM us, PM us if you have any questions, and subscribe to the link below, and we look forward to talking to you real soon. Thanks so much. Thanks for watching. Make sure you like and subscribe for weekly content. Also, check out our social media pages. The links are in the description below. See you next week.